There is a moment that almost every person alive has experienced, and almost nobody has ever truly understood. You are standing in a store, maybe it is a grocery store, maybe it is a gas station, maybe it is just a cafe where you used to buy your morning coffee without thinking twice, and something feels different. The number on the screen is higher than you remember, not by a little, by enough, not dramatically, not catastrophically, just enough to make you pause for a second, do a quick calculation in your head, and then quietly accept it and move on. You tell yourself prices go up. That is just how it works. That is what everyone says. And so you believe it, and then you forget about it, because there are other things to think about, and life does not slow down for small confusions. But here's what nobody ever told you about that moment. It was not random. It was not inevitable. It was not the universe simply doing what the universe does. It was not simply the market doing what markets do. In that moment, that quiet, forgettable, completely ordinary moment at a checkout counter was the end result of a decision made weeks or months earlier by people whose names you have probably never heard. In a building you have never visited, through a process you were never invited to observe or question. And those people, in that building, in that process, have more influence over the shape of your financial life than your employer, your government, or anything you will ever personally decide about money. More than your salary negotiations, more than your savings habits, more than any financial choice you will ever make on your own. This is the story of central banks. And by the time this is over, you will understand something about the world that most people spend their entire lives never quite seeing clearly, not because it is hidden, but because nobody ever bothered to explain it in a language that felt human. Let us start not with economics, but with something far more human. Imagine you are playing a board game, one of those long, complicated ones, where players collect resources, build things, and try to outmaneuver each other toward some final goal. Everyone starts with the same rules. Everyone plays by the same board. Now imagine that somewhere in that game, there is one player who does not collect resources the way everyone else does. This player has a special power. They can add more money to the game at any time. They can also decide how expensive it is for other players to borrow money from the bank. They alone set that price. They can influence whether the currency everyone is using holds its value or slowly loses it. They are not winning the game in the traditional sense. They are not accumulating the most properties or the most points, but in a very real way, they are running the game. Every other player's strategy, every other player's success or failure, is operating within boundaries this one player quietly defines. The rules everyone else is playing by are rules this player has the power to quietly rewrite. That player is the central bank, and the game is your economy. Central banks were not born from a conspiracy or a secret plot. Their origin is actually far more mundane and, in many ways, far more interesting. They emerged from very practical problems that governments and merchants faced centuries ago, problems that threatened to bring entire economies to their knees. The need for a reliable lender of last resort when financial panics struck, the need for a stable currency that could be trusted across borders and transactions, the need for some institution capable of holding the financial system together when private actors could not. These were real and urgent problems that demanded real solutions. The Bank of England, one of the oldest central banks in the world, was established in 1694 not as a sinister power center but as a solution to a very specific problem. The government needed money to fund a war and had no reliable way to raise it. Simple as that. A financial problem needed a financial institution. A group of private investors stepped in, lent the government the money, and in return received the right to issue banknotes and act as the government's banker. What began as a wartime financing mechanism eventually became the template for how modern economies manage their money. An emergency solution became a permanent architecture. The Federal Reserve in the United States was not created until 1913, and it was born out of a string of devastating financial panics that had proven, repeatedly, that leaving the money supply entirely to private markets produced catastrophic instability. These institutions exist because, in their absence, things fell apart spectacularly and painfully. So what does a central bank actually do, in the most straightforward terms possible? It does three things that matter enormously to your daily life, even when they feel completely invisible. It controls the interest rate, the price at which money can be borrowed anywhere in the economy. It manages the supply of money flowing through the economy, expanding it or contracting it depending on what the moment demands. And it acts as the anchor of trust that holds the entire financial system together, the institution that steps in when everything else threatens to collapse. Each of those functions sounds technical until you translate it into a real life. Then it becomes something else entirely. Take interest rates first, because this is the mechanism most people have at least vaguely heard of, even if they have never understood why it touches them so personally and so constantly. When the central bank raises interest rates, the first thing that changes is the cost of borrowing for commercial banks. The everyday banks that hold your savings and approve your loans. Those commercial banks then pass that cost on, and the ripple moves outward through the entire economy like a stone dropped in still water. Your mortgage becomes more expensive if it has a variable rate. The business that was planning to borrow money to expend decides to wait. everything slows down. Just slightly, but everywhere at once. The landlord who is planning to buy another property does the math and holds off. All of these decisions made by individuals and businesses responding to their own circumstances are actually responses to a single number adjusted in a meeting room. And together they slow the entire economy down in a coordinated, invisible way. The central bank knows this. It is often the entire point. When inflation is rising, when prices are climbing faster than feels sustainable, the central bank raises rates deliberately to cool things off, to make money more expensive and therefore less abundant, to slow the pace of spending and bring prices back toward something stable and manageable. But here is where the story gets genuinely complicated, and where the human cost of these decisions starts to become visible in ways that the official language never quite captures. When a central bank raises interest rates, the pain is not distributed evenly across the population. Not even close. The person with a variable rate mortgage feels it immediately and acutely, their monthly payment rises, sometimes significantly, sometimes overnight. The person renting an apartment may feel it slightly later, when their landlord's financing costs rise and those costs get passed through to rent without any announcement or apology. The person who has saved diligently and kept their money in cash will find that their savings now earn a slightly better return, perhaps the only group that benefits directly and immediately from rising rates. But the person who owns stocks, or real estate, or other assets, may see the value of those assets fall as money becomes more expensive and investors recalibrate. One decision, one number. An entirely different experience of that decision, depending on where you stand in the economic landscape. This is the hidden politics, buried inside what looks, on the surface, like pure technocracy, like neutral, apolitical number management. It is anything but. Now we need to go somewhere that most financial explanations politely skip over, because it requires confronting something genuinely strange about the nature of money itself. You probably grew up with a more or less instinctive belief about where money comes from. Governments print it, mints produce it, the treasury issues it, and all of that is true for the physical bills and coins that represent a small fraction of the total money in existence. A surprisingly small fraction. The kind of fraction that, once you know it, makes you look at a banknote very differently than you did before. But the overwhelming majority of the money circulating in any modern economy was created not by governments, not by mints, not by any public institution at all. It was created by commercial banks, in the act of lending, in the ordinary, everyday act of approving a loan. When a bank approves a mortgage, it does not reach into a vault and count out existing money. It creates a deposit new money right there in the moment of approval. The money did not exist before the loan was made. It exists now because the bank decided the loan was a reasonable risk and typed the numbers into a ledger. This process, called fractional reserve banking, means that the total amount of money in the economy is not a fixed quantity, carefully managed by a central authority. It is a constantly shifting number, expanding when banks lend freely and contracting when they pull back. It breathes, it moves. It is alive in a way most people never realize. And the central bank's primary lever of control is influencing that process, making it more or less attractive, more or less possible, for commercial banks to create money through lending. When you understand this, something genuinely shifts inside the way you see the financial world. Money stops being a neutral, natural thing that simply exists in the world. It becomes something that is continuously made and unmade by decisions that happen to be insulated from the kind of democratic accountability we expect from other institutions with comparable power over our lives. When the global financial system came to the edge of catastrophic collapse in 2008, central banks around the world faced a situation their conventional tools could not adequately address. Interest rates had been cut to near zero. There was nowhere left to go in that direction. The usual lever had reached its limit, so the Federal Reserve, followed by central banks in the United Kingdom, Europe, Japan, and elsewhere, did something that had been theorized but never deployed at this scale. They created new money, electronically, and used it to purchase financial assets directly from commercial banks. They conjured money into existence and spent it. The intention was to push money into the financial system, drive interest rates on longer-term assets lower, encourage lending, and prevent the deflationary spiral that had turned the 1930s from a bad recession into a decade-long catastrophe that scarred an entire generation. This was quantitative easing, and it worked, in the sense that the catastrophe was averted. The financial system did not collapse in the way it might have. But the consequences of that success, the way the medicine reshaped the body, alongside the illness, are still working their way through the economy and through individual lives, in ways that deserve far more honest reckoning than they typically receive in public conversation. Because all of that new money did not flow equally to everyone. Money is not water. It does not find its own level and distribute itself democratically across a landscape. It flows toward existing concentrations of capital. It finds its way to the places that already have the most of it. When cheap money floods a financial system, it finds its way into assets. Stock prices rise, not because companies have suddenly become more profitable or more productive, but because the cost of capital has fallen and investors pour their resources into anything that offers a return. The numbers go up. The headlines celebrate. But the underlying reality is more complicated. Real estate prices climb, not because cities have suddenly become more livable or more desirable, but because cheap money makes property an attractive asset. The people who already hold these assets see the value of what they own increase dramatically. Through no particular effort or insight of their own, they simply owned the right things at the right time. And the people who do not yet own these things find that the entry price has risen while their wages have not kept pace. The ladder has moved upward while they were still climbing toward it. This is not an editorial opinion about whether quantitative easing was the right policy, but the argument that it was without winners and losers is simply not supported by what actually happened. Inflation is the concept that ties all of these threads together, and it is also the concept most badly explained in public discourse. Reduced to a single number that somehow carries the weight of everyone's experience of economic life simultaneously. As though everyone's life costs the same things in the same proportions. At its most basic, inflation is a measure of how quickly the general price level is rising, which is to say, how quickly your money is losing its ability to buy things. A little inflation, running at something like 2% per year, is the explicit target of most major central banks. They want prices to rise gently, consistently, because this creates an incentive to spend and invest rather than hoard. But it is worth sitting with what that actually means across a lifetime. 2% per year, compounded over 30 years, means that something that costs $100 today will cost approximately $180 when your children reach adulthood. That erosion is quiet, continuous, and completely by design. The purchasing power of money is not just eroding, it is eroding on purpose, as a deliberate feature of the system. And almost nobody who experiences that erosion day by day was ever asked whether they consented to it. It is a policy choice dressed up as a law of nature, and the number itself, the official inflation figure, carries a kind of false precision that obscures more than it reveals. Every country's central bank publishes an inflation figure, based on a weighted basket of goods and services meant to represent average consumption patterns. The problem is that no one consumes exactly the average. Nobody lives an average life. If you own your home, the rising cost of rent does not affect you. If you rent, and rents are rising faster than the general price level, your personal experience of inflation may be dramatically more severe than the headline figure suggests. Two people, same economy, completely different realities, hiding behind the same number. The number they publish is real. It is also a deeply imperfect reflection of the reality that many people actually live inside. And the gap between those two things, the official measurement and the lived experience, is where a great deal of quiet economic suffering tends to accumulate unseen. There is a chapter in this story that centers on 2008, and it cannot be told without a certain kind of honesty that official accounts sometimes avoid. The largest banks in the world had built a system of extraordinary complexity and extraordinary risk. And for years, that complexity had generated extraordinary profits. Mortgages had been extended to borrowers who could not sustain them, bundled into products whose actual risk was misrepresented, sold to investors around the world who did not understand what they were buying, and layered with derivative bets that amplified the underlying exposure into something genuinely dangerous to the entire system. When the system began to crack, the interconnection meant that a failure in one place threatened to cascade everywhere. Central banks responded with emergency interventions of a scale and speed that had no modern precedent. The tools were deployed faster and more aggressively than anyone had previously believed possible. Institutions that had taken enormous risks and made enormous profits from those risks were, at the critical moment, stabilized, backstopped, and in some cases directly rescued. The losses that could not be avoided were distributed through unemployment, through reduced credit availability, through a decade of slow and grinding growth across the broader population. The workers who had no connection to the decisions that created the crisis, the small businesses that had nothing to do with complex derivatives, the ordinary savers who simply had their money in accounts and watched the economy contract around them. They bore a disproportionate share of the real human cost of a crisis they did not create. This is not a claim that the interventions were wrong or that the alternative would have been better. It is simply an insistence on seeing clearly what actually happened, because seeing it clearly is the beginning of being able to ask better questions about how these systems should work and who they should ultimately serve. There's a new chapter beginning now, and it is one that will shape the relationship between central banks and ordinary individuals, more directly and more profoundly than anything that has come before. Central bank digital currencies, CBDCs, are no longer a theoretical proposal sitting in an academic paper. China has deployed a version of one. The European Central Bank, the Bank of England, and the Federal Reserve are all at various stages of researching, consulting on, and in some cases piloting their own versions. This is not a future conversation. It is a present one, happening right now, largely without the public audience it deserves. A CBDC is, at its most basic, a digital form of national currency issued directly by the central bank rather than held in a commercial bank account. This sounds convenient, and it may well bring real conveniences. Faster payments, easier access, reduced friction in everyday transactions. The pitch is compelling, but it also represents something historically unprecedented. The possibility of a financial instrument that combines the universality of cash with the trackability of a digital ledger. Every transaction you make with a CBDC could, in principle, be visible to the issuing institution, not because of some nefarious plot, but simply because that is how digital ledgers work. Transparency is a structural feature, not an optional setting. And if the currency is programmable, if it can be designed with rules about how it is spent, when it expires, what categories of purchase it permits, then the central bank's ability to shape individual financial behavior moves from the indirect, aggregate level at which monetary policy currently operates to something far more specific and far more personal, something more intimate than anything we have ever seen before. These are not decisions being made by shadowy figures in secret. They are being made by researchers and policymakers who publish white papers and hold public consultations. But those consultations have not yet reached most of the people whose lives they will most directly affect. And that gap between the pace of institutional decision-making and the pace of public understanding is itself a form of power that deserves to be named. Money is not a neutral tool. It is not a natural phenomenon, like gravity or weather, that simply exists and operates outside the realm of human decision-making. It is a social technology, something that only works because enough people agree to behave as though it works. And like all social technologies, it can be designed in ways that serve some people better than others. And it can evolve in ways that either expand or contract the freedom and dignity of the people who depend on it. The central bank is the institution with the most power to shape that technology, to determine who it serves and who it quietly costs, whose lives it makes easier and whose it makes harder, often without either group fully understanding why. The moment at the checkout counter that this began with the slightly higher number, the quiet calculation, the shrug, and the moving on, contains multitudes. It contains the distant echo of a policy decision, the accumulated weight of years of monetary choices, the invisible transfer of value that happens continuously and without announcement between those who benefit from the current configuration of money and those who bear its costs. You did not create that moment, you did not choose the conditions that produced it, but you are living inside it, making decisions within it, building your life around it. And there is something genuinely important about knowing, really knowing, not just vaguely sensing what it actually is and where it actually comes from. The next time you hear that a central bank has changed interest rates, or that inflation has risen, or that a new digital currency is being tested somewhere in the world, you will have a different relationship with that information than most people do. A more honest one, a more useful one. Not a relationship of fear, and not of cynicism, but of clear-eyed understanding, the kind that allows you to ask better questions, make better decisions, and participate more fully in the conversations that will ultimately determine how these systems evolve and who they evolve to serve, because they will evolve. The question is whether that evolution happens in rooms where most people have no presence and no voice, or whether enough people understand what is at stake to demand a seat at the table. That question will be answered not by economists or policymakers, but by ordinary people choosing whether or not to pay attention. Money is the system through which almost everything in modern life is mediated. The people who understand that system, who can see it clearly, who can trace its mechanisms back to their source, who can identify the choices hidden inside what presents itself as inevitability. Those people are not just financially literate. They are something more important. They are awake inside a world that very much prefers them to remain asleep. And being awake, it turns out, is the most powerful financial decision you will ever make.